Good morning all, I hope you are well and welcome to another one of my videos. So I have two pairs on watch today, those are Pound Aussie and Pound Kiwi, the sister pair to Pound Aussie. So I'm going to break them down for you now. I have just taken off of watch Euro Aussie because it looks like it's just messing about a little bit now. A lot of the entries that I've been looking for have just been messing around. Price has been messing around quite a lot this week, but that's trading. Sometimes that happens for a whole week. Sometimes it can happen for several weeks. And then sometimes all of your entries shape up all at once. And the problem with taking your foot off of the gas, and I have done this in the past, when all of your entries or prices just messing around, is that when they do shape up, you're not actually prepared or you're not actually at your chart, and then you don't take the entries, and then that affects your psychology, and then it just spirals. So it becomes a vicious cycle. So you have to stay sharp, even when your entries are not shaping up, even when price just messes around, because at the drop of a hat, price can move into your area of value, and you're scrambling around because you're not ready, because you've lost concentration, and then you're in a kind of panicky, agitated state, which is not the best state of mind to be trading in at all. So so I'm going to break these pairs down for you now. Anyway, let's do this. Right. So why am I looking at Pound Aussie? I am looking at Pound Aussie because the things that stand out to me, we have a high up here, but this is too far away from where price is, and for me to worry about, considering what price has done. So what has price done? Well, as I see it, if you look very carefully, we have this sharp move here. We have this sharp move up, followed by a sharp move down. That tells me, when it's sharp, that there was likely a lot of liquidity placed in this area in a short period of time. Okay, sharp move up, a lot of orders were placed here. Sharp move down, the entries were filled. Of course, people have stop losses, and people know that people have their ray lines plotted in these areas. And there will be people putting limit orders above them for the sell, especially when we wick towards that area. I would have preferred it if this was full-bodied price action, but we wick to the same area again and we push back down. What does that mean? That means that many people will have their ray lines on, just as we have, and that this is potentially an attractive area of value for a sell. Now, what we also know is on the higher time frames that when price breaks above here, many of the news platforms, brokers, etc., will put out messages saying that Pound Aussie is at a 3-year high, 3.5-year high, and they do this to encourage the FOMO. So price breaks above. Apparently, this is now support. These news feeds put out their news. People start buying the highs, thinking it's going to go to the moon, quote unquote. And what we see in the majority of cases, when areas like this are higher time frame liquidity points, so on the daily chart and above, what we typically see, sometimes on the lower time frames, but definitely more so on the higher time frames, is price pushes above, and then it crashes to the downside back beneath what was supposedly support. So that's why we don't trade support and resistance in its conventional form. We are aware of the levels, but we don't trade it in its conventional form. So the next thing that I notice when I'm doing this is that we have a near miss. Okay, when we have a near miss, price will often find its way back down or up to the area that it near missed to before the move in the other direction could occur. So when I see this as a near miss to here, I've just cut through this wick just because it looks like a volatility wick. This is a volatility wick, but it's wicked to something significant. So as I said in my previous videos, when we have a structural low, so we have this piece of structure here, and the base of the piece of structure happens to have been near missed, that is an even bigger indication that this near miss will be filled, because that's a good area that people will likely take profit. You can see it in the other direction as well. If we had our ray line plotted here, you can see that price comes up, it comes up again, it kind of near misses here, finds its way all the way down, but still manages to break that high before moving to the downside. So we see these near misses everywhere. Okay. So the first question I asked myself, it's quite a simple one, this trade. Am I well positioned for a move to the downside? Well, yes. We've broken above the high, broken back in, caught people the wrong side of the market. We have the near miss down there, as I've just touched on. So, is there anything about this at this moment in time to suggest a move to the upside, that price is just going to blast to the upside? No, there's nothing about that that indicates that at all on the higher time frames. And as I said, even if we were to reverse or stall from this low here, we have a lot of profit potential to the downside before we even reach that area. So, in my opinion and experience, I am very well positioned for a move to the downside. Um, what do we have now? So the next thing I ask myself is about the sequence. We start off with this correction here, which is quite large relative to the impulse down, which has preceded it. However, after that, sometimes that can happen when for example, the confidence needs to come into the market. So the confidence might have been a bit shaky, especially when we're kind of in the middle of nowhere. We're between this ray line and the one far above. So sometimes that happens when we're kind of in the middle of nowhere. But then we get an impulsive move down, then a correction which is more kind of proportionate, which is more of a proportionate pullback to the move down which has preceded it, and then a bit more confidence starts to come into the market. We see the big push down and these impulses and corrections, impulse correction continuations, impulse correction continuation, correction continuation, and so forth. Okay, giving me a clue that the confidence is well and truly in. So it's not the greatest sequence in the world, but it's certainly a good sequence as I see it, especially on a pair like Pound Aussie, which does tend to correct for longer before committing in one direction or the other. And then you can see we've just dropped out of this correction here and we're trading well below it. And that gives me a clue that the sequence is reliable and that we're well positioned for a move to the downside. Now, what have I been saying just a moment ago? I said to you previously that there was a trade in here. I know some people took it. I know actually Mark, who actually teaches me to trade, took this entry here. I don't personally take them. In my experience, this is a high quality setup, but a high risk position. And the reason it's a high risk position getting involved in here, I'm not going to break down the exact entry. I do know where people would have got involved there that trade the same way as me. I don't like to manage the reason I don't take entries like this typically is because you have to manage them aggressively, because typically price will come down and then come back aggressively as it's done here. And the reason that is because we have this sharp move up, sharp move down. That tells me that a lot of liquidity, a lot of orders were placed in this in this area very quickly. Okay. And that there's a lot of liquidity there. We come back up to that area, but we near miss it. We don't quite tap into it, and we certainly don't break above it. We then move down. Excuse me. We then move down very correctively before we correct afterwards. So this was not an impulsive move down before the correction, giving me a clue that there was not enough liquidity where price tapped into for it to move down aggressively. And the likelihood is because all the liquidity was sat there and just above it. Okay, so what does that mean? That means that if I was to get involved, I mean, this was good, this entry, in terms of we were trading below this low. This impulse was a solid impulse down. This correction was proportionate to that impulse, but because of factors just expressed, it is likely that price will come down and then come back up aggressively, meaning that if you did get in here, you would have to manage this aggressively. And I, due to personal reasons, I genuinely don't have the time to be, managing things aggressively like a hawk, in order to get my risk off the table. So I don't typically take these positions. But what do we have now? We have this 1, 2, we have a near miss again, okay? We have a near miss to here, and to the area of value. And how does it move down from there? It moves down correctively. What does that mean? That likely means that some people are trying to sell this. There may have been people waiting patiently for price to get to this area of value. It gets closer and closer and closer and closer. They see it start to sell off. FOMO kicks in. So some people would have experienced FOMO. They start selling, and we see this very corrective move down because of, most likely, there are orders here which need to be filled, which are dragging the mid price up, which is causing causing this corrective move down. I'm just going to have a drink of water quickly because my voice is being problematic. Right, let's try again. So yeah, that's why price is moving down correctively. People are selling this whilst there are orders being placed in this area, and there are orders still at this area, which are dragging price up, which is often why we see the second touch of a piece of structure which narrowly misses an area of value. So with that in mind, what I'll be looking for from this pair today, and this may not be ready by today, the only reason really that I've got this on watch is because there is a lot of, I think it's manufacturing data coming out of the UK and the European Union, which may act as the catalyst. If we had 2 or 3 bullish candles, we would be up in this area, and then we would have that kind of parallel structure which we typically see. I believe there's some economic data. We don't trade the news, but we're aware of it because it can act as a catalyst and can cause a bit of volatility, which sometimes you would wish to avoid. Okay, until the volatility is passed. So what I'll be looking for today, with that being said, is a move up to this area. Of course, if that was to happen by the end of the day, then the move would be very aggressive. I wouldn't be looking for a risk entry from here, which is where we essentially call the top of a piece of structure, because if this was to occur by the end of the day, if price was to move up to this area, then this trend line wouldn't quite marry up. Okay, so when that happens, what typically happens is it breaks out of the structure and then breaks back in. So it would perhaps be a different story if this trend line actually lined up with that area of value, but because it doesn't, what I'm going to be looking for, and because the move up would be very aggressive, I would be looking for a pushback down. So I want price to tap into this area, followed by a pushback down, and then I will be looking to get short either on the break or within a flag such as this, and then I will be able to manage it down to this area easily for something in the region of 7 or 8%. Of course, if we reacted from here, then I will be able to manage it to the trend line, which we would have plotted for something in the region of 6%. So that is pound Aussie. As I say, that may not be ready by the end of the day, but we shall see. Now, I am less likely to take pound Kiwi for the simple fact that the spreads get higher, get noticeably higher on pound Kiwi. And if I was to hold this over the weekend, a trade on pound Kiwi, I will be less likely to do so because of how wide the spreads get. But we shall see what happens. So, what's happened on pound Kiwi? We have this sharp move up, sharp move down, giving me a clue that there's a lot of liquidity in this area. What do we have here? We have, after that, we have non-progressive price action. We have a sharp move up and a sharp move down. What was that sharp move up? It could likely have been orders being placed in this area by the swing traders. We have a 1, 2, and a 3, which narrowly misses this area here, and we have this overall non-progressive price action. So when we see a correction which is this wide relative to the move down which has preceded it, that is a very, very strong indication that we're going to come back up to this area, because it's completely disproportionate, which means that this is non-progressive price action. Okay, I've just cut through this volatility wick here because it doesn't really make sense in terms of this structure. Structures are usually more parallel, so this just looks like a volatility wick. And if this is a volatility wick, then we essentially have a near miss to here, where price got close to it and didn't quite tag it. And we have a near miss to here, making it even more likely that price will find its way down to this area before any reversals to the upside. So then what do we have here? We have what we call an ending structure. We have a 1, 2, 3. The second touch narrowly misses here, which I was just talking about a moment ago. We break above. What happens? News feeds, etc. They put out things saying that pound Kiwi is at 3-year high. What happens? It breaks above. People pile in thinking this is going to the moon. Support resistance is now apparently support, and then it comes crashing to the downside. And as I said yesterday, it doesn't mean you can't make money in these areas, but if you're constantly essentially buying the highs and selling the lows, then obviously in business that wouldn't be something that you would do. And if you constantly bought the highs and sold the lows, you wouldn't be profitable long term. So we've come crashing to the downside, just as we have with pound Aussie. So I asked myself, am I well positioned? Well, yes. Even if we were only to make it to the base of this structure here, which we call the 90% rule, because when we break a trend line such as this, we have a 90% chance of getting 90% of the way to the start of the bottom. Even if we were only to get to there, there's more than enough profit potential. This is a completed structure. There's no need for price to just suddenly reverse to the upside, although price can do anything at any time. So yes, I'm well positioned. You can see there's lots and lots of momentum to the downside now. So next thing is sequence. Okay, so if you look at this, we have this move down. We have price coming down to potentially fill. Often these wicks get filled before the move to the downside can occur. So when I see a daily candle like this, this is not typically a candle which is indicative of a move to the downside. This is a bearish high test, and if we're looking for a move to the downside, often these bearish high test candles get filled, price comes back up, and then the move to the downside occurs. So that's one thing in my thinking. Okay, what do we have here? Same thing. We have a bearish high test in a bearish run. Okay, so we're essentially most likely filling this bearish wick for a move to the upside before the move to the downside can occur. So with that being said, what's the sequence like? If we just look at the sequence in my opinion is better on this one. Okay, because we start with a smaller correction, impulse, smaller correction into a larger correction. This was again disproportionate slightly to the move down which preceded it, but then sometimes that happens, especially with pairs like pound Kiwi. Then we have the tighter corrections into the slightly larger ones, into the smaller ones. And I've just been logged out of my broker for some reason. Okay, so we'll just ignore that for a second and deal with that later. And one of the reasons this is last on my list is because if you look at pound Aussie, there's nothing above this structure, no inflection points that price might gravitate up to before a move to the downside could occur if it was to push up to this area. However, with pound Kiwi, there's all these little mini inflection points which price could tap into. So it would certainly be more risky to take a risk entry from the top of here, because price could trickle up to here, or even this one here, or even perhaps retest the back end of this. Okay. But nevertheless, it looks like, once again, if we just look at we've got the 1 hour as well, it looks like we're potentially filling this bearish 1 hour high test before pushing up to this area of value, which price tapped into, but it didn't quite break above. If you just look here, I think we narrowly missed that area, so there's likely still liquidity there. We did fall down impulsively to start with, but then we've kind of corrected down to this area. So what I'll be looking for is the following. As I say, I'm less likely to take this just because if this was to shape up, then holding this pair over the weekend, holding a trade on this pair over the weekend, I would be much less likely to do, just because of the spreads, how wide they get. But if we push up to this area, if those economic data releases actually give price the legs it needs to push up to this area by the end of the day, as unlikely as it looks at the moment, then I would be looking to get short. I would be looking for price to push back down and then flag, and then I'll be looking to get short on the break of the flag or within it, and then I'll be able to manage that easily. We would have that completed piece of structure for that potential move to the downside. As I say, whether these entries shape up or not is a completely different matter. I certainly wouldn't be taking an entry in this area here. We're kind of trading mostly above that low and just above that wick. So if you took an entry in here, you'd likely be tagged, much more likely to be, if price is actually just filling this wick and filling those other wicks that I talked about, those bearish wicks, you're more likely to be tagged in, tagged out as it fills the wick, and then price pushes up. So again, that would be another another example of a high risk position. So anyway, folks, I hope you've taken some value from this. I shall bid you a great day and a great weekend, and providing I have a pair or pairs on watch, hopefully I'll get another entry by the end of the month. But we shall see what happens. Then we just are here to execute, and then the market will do what the market wants to do. So thanks for watching, folks, and I will see you again soon.